Good afternoon and welcome to another episode of ANPA Financial Webinar. Today we have an exciting topic. This webinar is co-sponsored by ANPA and ANPA Foundation. Today is our 24th webinar since 2020. The topic of today's webinar is Diaspora Investment and Charitable Life Settlement Fund. And I'm sure most of us don't know what that is, but I guarantee you by the time you finish this webinar, you will learn so much about this rare investment opportunity that allows you to do good while doing well. Before we start, I would like to introduce our national president, Dr. Chichi Anyogo.
Hi, everyone. Thank you, Stanley. Thank you for being the champion of this financial seminar over the years. You know, ANPA's vision is a healthier Nigeria and a healthier world. And wellness is actually all embracing. It's the act of practicing healthy habits to have better physical and mental health outcomes. And it includes a lot of things, including financial health and the ability for you to practice your passion without the encumbrance of worrying about how you're going to pay later. So without much ado, and I'd also definitely recommend that the benefits are appreciated, including the opportunity for professional development within the organization, leadership opportunity, referrals from collegial and inter specialty referring, the ability to network with members within and outside the organization, and in general, just that general feeling of you get when you're able to talk with people who you connect with on other levels. We're about to go into our medical mission next month. Actually, next month is a day from now. And I'm hoping that we'll see a lot of you that we see here in Ota, Nigeria in the next 3 weeks. And so thank you, Stanley, for everything. And I appreciate everybody coming on. I think you have some more people coming too. So this is going to be an exciting morning. Thanks a lot.
Thank you very much, Dr. Anyogo. And for those who are looking to connect with ANPA, we are on Instagram, Facebook, and Twitter. Our members can get more information from anpa.org. Again, this is a co-sponsored webinar. We used to do this monthly. I think we've covered every financial topic that is possible. So we've gone to a quarterly webinar series right now. For those who, if you feel like you missed something, if you go to the ANPA YouTube page, you can listen to any of the previous webinars, which are still very valid today. They're free to us, and we guarantee that this will be the highest and best use of your 1 hour. We've intentionally brought in the best subject matter experts. Without further ado, I just want to give a quick disclaimer. The materials presented at all ANPA financial webinar is for general education purposes only, and is solely the opinion of the presenter. No webinar is intended to provide personalized financial or legal advice. It is left to your discretion and judgment, and is the sole responsibility of each attendee to determine what is necessary for his or her own practice. Neither the speaker or ANPA can be held responsible for the materials, opinions, or inadvertent errors or omission in the presentation, or preparation and presentation of the material. Furthermore, nothing in this material should be construed as an endorsement by ANPA. With that said, this is what we're going to talk about today. This is another financial disclaimer. A little bit about ANPA Foundation. ANPA Foundation was formed by ANPA to raise funds for ANPA programs and to help pretty much support the ANPA goals, which is a healthier Nigeria and a healthier world. We do this by obtaining sponsors and donations. One of the things that we're trying to do is create an estate planning where ANPA is part of your estate plan for the future of ANPA. This is the current ANPA board members. And in the interest of time, I'm going to introduce Enyi Kanu. Enyi Kanu, you guys know him very well. He's a good friend of ANPA. He's been he's a well-sought author. He's been with ANPA for a long time. He needs no introduction. I'm not going to read anything about Enyi because it will make his head get any bigger than it is right now. We will fit to the speaker. So Enyi can take it from there.
Stanley, thank you very much. Good morning, everyone, and welcome. And for those of you who we didn't reach on Doctor's Day, belated happy Doctor's Day to all of you, and thanks for everything you do for our community globally. You guys are truly the best. I want to talk about philanthropy, which is what this is about. Philanthropy, as you can see, is making your private contributions for the public good. The vehicle for us is the foundation. The mission is a healthier Nigeria in a healthier world. Philanthropy is the desire to promote the welfare of others by the generous donation of money to good causes. You guys, in choosing the medical profession, intended and intend to promote the welfare of others in healthcare. So thank you again for that. Philanthropy is and includes charitable acts or other good works that help others or society as a whole. The president a few minutes ago talked about the medical mission. Another one of the missions that they undertake on an annual basis, multiple missions to provide multiple solutions and continue to contribute to the world. What we are going to speak about today is the Diaspora Investment and Charitable Life Settlement Fund, titled Do Good and Do Well. Do good and doing well. It is anchored in the mission of the foundation, which is to provide resources to support ANPA's mission, financial resources, in-kind resources that will support ANPA's mission. The foundation that you were introduced to have deliberated on a number of things and ways to raise money for the foundation and for ANPA. And the fund and the foundation members, the advisory board, decided on a number of things, which include this life settlement fund as a very good way to do this. There are a couple of others that we're still working on, which include a guaranteed issue life insurance policy, disability type stuff, and so on. All of these things would be beneficial to ANPA members and also help with funding ANPA's missions and things like that. And also, very specifically, offering to those who directly donate to the foundation some tag-on access to experts and expertise with a minimum value of about $10,000 in expert resources that you would have access to. Again, we'll talk about that some more down the road. Let's come to this one that we have agreed on and are presenting to this group today. This fund, our initial capital raise is $5 million. Quite frankly, that's not a lot usually in these things, but what we like to do when we embark on some of these things is we like, yes, think big, but start small. And then we're going to scale fast if this basically begins to gain hold. So $5 million is not a lot in the scheme of things when it comes to these kinds of things, but it's a good place for us to start. The mission here is to raise $5 million, and we kept the minimum investment at something reasonable. Now, this is an investment, by the way, that is not typically available to everybody. You have to be accredited in order to have access to investments like these, because these are usually available to institutions, large financial institutions, accredited investors. And for those of you who may not know what an accredited investor is, an accredited investor is someone who, if single, has an income of at least $200,000. In the last couple of years, they've made $200,000 in income. And if you're married, it's $300,000. And in the last couple of years, and we envision that you would do the same thing going forward. Or if you have a net worth of at least $1 million, not including your personal residence. So, you know, the healthcare industry is one in which the majority, if not everybody, would be accredited. So this is one of such investment solutions and options that's available. There are a number of others that are typically available to only accredited investors. So what we did is we pretty much have co-sponsored with the foundation this particular life settlement fund. I happen to be one of the fund managers, involved in a couple of fund, life settlement funds with the Biltmore Fund. Frank is co-manager with me on this fund. We would basically be involved in the due diligence and all those kinds of things as far as the fund is concerned, selection and all that stuff. I'm managing the fund. So Frank O'Donnell is principal at Biltmore Consults and Automotive Services. AJ, which is a life settlement funder, is also involved, and there are three parties, three of them involved here that would speak to exactly the life settlement fund, and hopefully will come back at the end and answer questions that you may have and so on. So AJ, Frank, I'll let both of you, and Alex, I'll let all three of you kind of dive in here and speak to the fund, and we'll answer questions at the back end. Thank you.
All right.
Great. First of all, this is Frank O'Donnell. I just want to say good morning and thank you very, very much for everybody taking their time out of their Saturday to join us. I think you're going to be really excited about the prospects of not only doing well for yourself in terms of investment returns on investment, but also doing good for Nigeria, for the people of Nigeria, and for people in general. It's an exciting option. So I'm going to turn it over to AJ and have him take you through this first part of the presentation. And please ask questions. You can use the chat notice if you want, or just chime in. We'd like to make this a discussion as much as a learning opportunity. AJ?
Thank you, everybody. It's nice to be here. This is Alex Jones with R.A. Jones Financial. I'm with Richmond Life Settlement. What Richmond does for its clients, essentially, we evaluate these insurance policies as they come in. And I'm going to go in depth about what life settlement is, momentarily in some of the other slides. But this is just about us. So we evaluate the policies to see if they're investment grade and they should be sold to an investor. We then work with the insurance companies to reduce the premiums, right? So when you're buying a life settlement, what you don't want to do is you don't want to pay a bunch of cash to the life insurance company when they're building cash value in these life insurance policies, right? We tend to want to run these things at, like Alex likes to say, on 1/8 of a tank of gas. So we go in there, we sit with the insurance company, we find out what the true cost of insurance is, what the maintenance fees are in addition to that insurance, and that's the premium optimization that we do that allows our clients to pay lower premiums than historically are available. In addition to that, we help with portfolio management. Essentially, when I see policies that meet my fund manager's criteria, I'll segregate those policies out of our inventory, and then I'll send those up to our fund managers for review. And then we also handle the death claim, right? Because obviously that's one of the services we provide. We will get the death certificate from the family, the nursing home, wherever the death occurred. Then we'll submit the claim into the insurance company, and obviously our clients get paid a check on that. For the most part, 98% of our clientele are institutional, Berkshire Hathaway, private equity, charitable foundations, banks. We do some business with individual investors, but we tend to mostly gear towards the institutional clientele. Just to give you a little fact about Berkshire Hathaway and life settlement, Berkshire Hathaway buys $1 billion a month in life settlement cases. They're a big proponent of the business. Obviously, Deutsche Bank was a big proponent of the business. This is a very stable asset, and that's why these banks and these hedge funds and these institutions buy it. Next slide, please. So what is a life settlement, right? A life settlement is a transaction between a insured person, historically over the age of 65, and an investor. And what the investor gets is the life insurance policy. They become the beneficiary and the owner of that policy. And what the person selling gets is a lump sum payment for that policy. In addition, the new owner now takes care of the premium in perpetuity until the death event. Just so you guys are aware how lucrative the life insurance business actually is, 92% of all life insurance policies written in the United States historically lapse. They do not go to claim. And so what we do is we're taking an otherwise worthless asset to somebody, we're paying them cash for it, and then we make sure it does go to claim down the road. Next slide, please. Why do people sell their life insurance policies? Why is this such a popular business? Well, usually they can no longer afford it. They no longer need the policy. A lot of these people are overinsured, where they had 5, 6, 7, 8 policies that they throughout the course of their lives, and hey, they don't need it's too much coverage. They don't need it, and they're paying these huge premiums. They need to fund long-term care, medical costs for that matter. We've had people sell policies to go on vacation. We've had people sell policies to pay off their houses, so they can leave a debt-free home to their children. And again, it's people with multiple policies that are selling these to us. Next slide.
Yeah, I mean, just add a little color to it, Anthony. Tell the story about the woman who took her family on a cruise.
Oh, you mean she went on a cruise? Actually, I have Alex tell the story about the lady with cancer with the 90-day cruise.
Sure. So Alex Jones, I'm the owner and the funder in the space. So we had a gal up in New York. She was a workaholic, career person, 55 years old. Never wanted life insurance, hated life insurance, and she got $500,000 of group term at her accounting firm that she worked at. The beneficiary of the policy was her estate. She didn't even have anybody to leave it to. And we got a hold of her policy. She was ecstatic to find out that, oh my gosh, I'm going to be able to get something while I'm alive. After doing all her medical underwriting, she had double metastasized breast cancer. Our life expectancy that came back from our actuaries based her around 18 months. And she basically told us, hey, I'm not even going to fight this. So we asked her, what would you like for the policy? And she says, well, I've always wanted to go on a cruise. There's a cruise out of New York called the QE2, and it's kind of halfway around the world. So I said, go price this thing out and call me back. So I almost fell out of my chair. The cruise was $86,000. And we wound up providing her with $135,000 total for her policy. The premiums on that policy was $135 a month. She went on that cruise, wrote me a very beautiful letter, and 11 months later, she had passed. So these policies, funding these people, these policies, is doing an incredible cause for them. Everyone that sells their policies is so grateful, as they need the money, and they were going to just let it lapse. And the investor that purchased that policy obviously saw a hyper return upon her passing away. So,
Right.
you know, it's a nice fit.
You know, it speaks to the whole doing good, doing well, right? I mean, not only will we, within the investment, will we do good for ANPA and the ANPA Foundation, but, you know, we can do good for these insured people. I mean, this was a trip of a lifetime for this woman. She was able to take her family and spend at least the last 11 months of her life kind of in a really good place.
Let me put it in this kind of perspective for you guys. In the 13 years we've been in business, over 10,000 policies have exchanged hands. We've never been sued, right, by either a buyer or a seller in that total amount of time. What that tells you is that tells you that both parties are extremely happy with the transaction. The market size, I'm not sure if you guys are aware, in-force life insurance exceeds the mortgage market. It's 20 trillion of in-force life insurance. So there's plenty of paper out there for us to purchase. The market growth in our industry, when our industry at 2020 had a boom, went to 4.6 billion in institutional purchases, and life settlement market should sustain 212 billion by 2028 because it's becoming a much more popular asset now than it was just 13 years ago. Whereas we would be closing 100 transactions 5 years ago, we're now closing 250 to 300 transactions a month. So the parties to a life settlement policy are the policy owner, that is the person who originally got the policy on themselves. There's usually a seller's advisor, someone who's advising the seller, like a life insurance broker for that matter. That's who usually we deal with. They'll give us a call, or they'll give a life settlement broker a call, and then those people get in touch with us. We're the life settlement funder. We're licensed for this transaction. View a funding company as a title company, right? So what we do is, and if you go to the next slide, so what we do is first we review the policy that comes in. And there are over 1,700 carriers in the United States for life insurance policies. We only deal with A-rated companies or better. Prudential, Lincoln, Delaware. We deal with the top maybe 25, 30 companies in the business, right? Because almost company is going to be in business in 13 years, so you're going to be able to collect, or in 5 years, so you're going to be able to collect. So after that, we review the transferability of the policy. Right? Is it a term policy? Is it a whole life? Is it a universal life? And then we look to see if there's any riders that would prevent a payout. For a perfect example is suicide clauses, right? We would not buy a policy that had a suicide clause, a rider in it, right? Obviously, because that would exclude, in the event of that type of death, it would exclude payment to the investor. So if it has any riders that would prevent, we've seen riders for motorcycle guys that say, if you die in a motorcycle accident, we're not going to pay your life insurance. So we make sure there's nothing along those lines. Then we do what's called and you guys will appreciate this, we do a national prescription database pre-screen, right? We find out every drug that person who's selling the policy is on. And that'll allow us to see that, hey, this person's taking Lipitor, and that's the only thing he's taking, and he's been to the doctor once in the last 2 years. That's not a policy that we're looking at, right? That's not our wheelhouse. But we'll see somebody else. We'll see he's a 76-year-old male. He's on 14 different types of medications, three heart drugs, diabetes drugs, things along those lines. We focus on people who have chronic issues, and then those people will go to the next stage. And that next stage is medical underwriting. We pull all the medical records. They have to sign the HIPAA document. All the medical records get sent to us. Those medical records then go out to an actuary who is a professional who evaluates the medical records and gives us a report. And that report will say, with 900% accuracy, this person will be dead in 5 years. This person will be dead in 6 years. This person will be dead in 7 years. And they tell us the reasons why. And that 900% number it's an interesting number. It's like a batting average. Out of 1 million people that had these same things, and these same chronic diseases at this age, at this weight, 900,000 of them have died during this time frame, and that's where that number comes from. Is it a perfect system? No, but 80% of our life expectancies are accurate. They're on the money. And if you go out 2 years past life expectancy, so if you're seeing a 5-year life expectancy on the case, and now it's a 7-year life, so you go out 2 years past that, that number goes up to 96%, and we have examples of that. Once that's completed, we add the case into inventory. Next slide, please. So how does the process work, right? So how does an investor or a fund, how does it work? So the first thing that happens is the investor will tell me what they're willing to pay for. They will give us a range. They will say, we're willing to pay between 70,000 and 85,000 for this policy, no more than 85,000. So my job now is to negotiate with the seller or the seller's representative. And we represent the buyers. We represent you guys. We don't represent the sellers. My job is to get the best possible price for you guys so you get the best possible return. So once the offer is placed, it's either accepted or rejected. And if it is accepted, it moves on to underwriting. Now, there's a lot of things that happen in underwriting at this point. These are complex transactions. First, the investor escrows funds. Then the file goes to underwriting. The seller has to complete all the closing documents, which, by the way, includes every one of their beneficiaries and their spouses signing off and notarizing that they're aware that this policy is being sold and they will not be a participant in the future death benefit. Once the investor completes the carrier forms, those then go to the carrier for review. The carrier says yay or nay based on if there's a problem, if there's an erroneous date, or if the signature doesn't match or anything along those lines, the carrier will kick that back for us, and then we'll have to resubmit. Once that submission is completed at the carrier, the policy goes through a change. The insurance company will let us know that they've changed not only the owner information, but they've also changed the beneficiary. Now our client becomes the sole owner and beneficiary of that policy. If the person would have passed the next day, our client would be paid. Once that is verified at the insurance company, escrow was released. Next page, please.
So in this case, the client is the Diaspora fund.
Correct.
Yep.
So again, factors in evaluating these policies, like what makes us bid certain amounts for certain policies, and everybody has, all our investors have different wheelhouses, different things that they like. We have one of our funds that right now, strictly probability fund, right? They don't care about medical records. They don't want to see an LA. They just want to buy every 75-year-old male that they could get their hands on, or older. But they also have a specific buying box. They want to buy between 7 and 8 cents to face value, right? So on the $100,000 policy, they don't want to pay more than 8,000 on a policy like that. Then we review the estimated life expectancy. This is an important factor in seeing how long the tail risk is going to be for the premium. Of course, then we analyze the premium. And then what we do is we go out 2 years past life expectancy on our evaluations. And at that time, with the combination of what you purchased the policy for and the premium, if we're not seeing results over 20% per annum in that policy, we don't buy it. And then there's obviously the intrinsic value of the policy. Next slide, please. Okay, so how do we capitalize, right? There's 2 ways to capitalize in this business. The first way is buy and hold, right? We buy $1 million Prudential policy, we purchase it, maybe we pay $100,000 for it, we maintain the premium, which should be around $6,000 a year. We maintain, around $30,000 a year on a policy like that. We maintain the premium for, let's say, 5 years, right? So now you're into the policy for $100,000 plus $150,000 in premium costs. You collect $1 million when the person passes. The second way to make money in life settlement is like fine wine. These policies have vintage. The older the person gets, the more sick that they become, the more valuable these assets become. And our buying box is so low compared to every other company out there that these assets are extremely sellable. So when they come to us for a purchase, we're maybe buying it for 10 cents on the dollar, 15 cents on the dollar. that person will probably get an offer from Coventry at 40 cents on the dollar, at 30 cents on the dollar. So for us, we do an annual review of each and every single policy. We see which policies we can make the most amount of money on for selling them, and then we sell them for our clients.
That's an important part of the process. It's because it provides a liquidity solution where sooner than the actual death benefit. So we have several options when we're evaluating the policies as to how we can maximize our returns.
So this is an actual case study. This is one of the policies that we've sold. And we have two of them here just to show you guys how it looks. So here we had an 82-year-old male with a $250,000 death benefit. His life expectancy was 5 years. The premium price on the policy per year is $8,000. So, and this was purchased for $25,000. This was purchased for 10 cents on the dollar. So if this individual lived up until the life expectancy, the return on the investment is 44% per year. If he dies 1 year after life expectancy, it's a 33% per year per annum gain. And if he dies 2 years after LE, it's a 25%. So this is a buy for us. This is how
Dr. O'Curr, this is a bread and butter policy for us. The premium is low, 10 cents on the dollar in terms of the purchase price, and we know we're going to retain, we're going to make a significant IRR, and you can see Anthony talked about 26%. You can see kind of where that derives.
Okay.
All right, so next page. This is another case study, 75-year-old. This is $1 million policy. This again is well within our wheelhouse. This is a 5-year life expectancy. The premiums are a little bit more pricey because it's $1 million policy, about $30,000 a year. And we bought this policy for our clients for $150,000. And as you can see, the numbers still bear out. At life expectancy, you're still seeing a 45% return per year. At 1 year past, a 33% return. At 2 years past, a 27% return. This is what we like to see when we present our clients with what we believe the policy should go for, right? And by the way, if these numbers don't bear out, we walk away. If the person, and some people think that their policy is worth 50% of the face value. So when we have those kinds of situations, we'll look at 1,800 to 2,000 policies a month. We'll walk away and we won't chase. Next slide, please. Frank, I'll let you handle this one.
Yeah, so the benefits of, one thing I want to just kind of reiterate and dimensionalize, we talked about 92% of policies are not paid out. And then there's a $20 trillion market. So when you look at it, and it's not a direct correlation, but in terms of market size, that means $18 million worth of policies don't get paid out. The insurance company keeps that money. So the point is there's a very big pool that we can choose from, and we can be very, very selective in terms of the policies that we purchase for the fund. So when you invest in a pool, you're investing in between 50 and 100 different policies at any given time. So you're not necessarily waiting for one policy to mature. There are no premiums. There are no separate premiums. We set aside 30% of the investment that's provided for premiums. So the fund will cover the premiums until the life settlement or until we sell the policy. Each time a death occurs, you can withdraw your profit or keep it and add to the net value. So, on that $186,000 at 2 years after LE, we can reinvest that, or you can take a portion of it out. There are, I will tell you, just AJ is being humble. Alex and AJ are two of the premier professionals in terms of looking at and pricing policies, very disciplined. I think R.A. Jones, which Alex runs, is the largest life settlement funder in the country by volume. Anthony, you want to jump on that?
No, that's correct. We're the second largest by volume first largest by volume, second largest by dollar amounts.
You know, so it's not like they're looking at, you know, they're looking at 1,800 policies, you know, a month. They could probably look at 3,000, but you know, it's they're very disciplined in what they show us. So, you know, the one thing that is clear with these policies is that there's little or no risk, right? Low risk, let's call it. I mean, a person is going to pass away, you know, and again, keep in mind that 80% of the insured pass away within the LE, you know, and the number, as AJ said, climbs from there. But eventually, somebody is going to pass away. So here's an example of an existing pool. That has started to pay out. This pool, the IRR on the total pool here is 26%. But you see that the total cost in terms of buying the policies, management fees, premiums, you know, for this fund was $520,000. And the net return, the gross return was 1.7, 1.8 million. The net is $1.3 million. So what I want to talk about here, and I hope you all can see this, is again, this talks to our discipline in terms of picking policies, right? I mean,
so if you look at I'm going to jump in here real quick. So if you look at when the policies were purchased versus the actual hold period, you will see that only one of these policies, and this is an actual pool, right? So these were actually paid out. Only one of the policies went 1 year post life expectancy. This particular fund had 10 claim events. Now, what the investors in that fund have done is they've taken that money, they've taken that 1.7 million, and they've reinvested it. So now that portfolio pool is now worth $13 million in additional death benefit available. And years 5, 6, and 7 will be the biggest years for the pool because they kept their life expectancies at around 5 years. Right. So years 5, 6, and 7 will have the biggest payouts.
Right. But if you look at the quality, you know, again, our model is insureds that are over 65 years old. So you can see that life expectancy of 5 years or less. If you look at that, it's clearly kind of been successful. We generally target males as opposed to females because females live longer. And if you look at kind of where they passed or where the settlement occurred, it occurred well within the LE. So the model works is kind of what we're trying to point out here. You know, these are policies that are in force and active that the fund owns, and these will just continue to add to the IRR. But again, same profiles. You know, we stick to our model, which we have found to be successful. Now, one of the things that you'll see is that most of the policies that are purchased here are well below the $1 million, and we target that asset at that level because the larger life settlement funds, the Coventrys of the world, the Berkshire Hathaways of the world, they target the $1 million, $3 million, $4 million, $5 million. So we don't want to compete with them in terms of pricing. If we are, and I've learned this from both AJ and Alex, if we're bidding on a policy and Coventry comes in and they lay down a bid, we're walking because we just, you know, we don't have the resources that they have. But they generally don't play in this niche. So that allows us to buy the policies at the 7 to 10, 10 to 12 cents on a dollar. Now, what they will do, going back to the liquidity solution, is they will come to Alex and AJ and they will say, hey, you know, we want $5 million worth of policies for 79-year-olds that have, you know, 3-year life expectancies. And that provides us the opportunity to sell it at, as AJ was saying, where we were buying it at 10, we're selling it to them at 40.
Yeah, just to give you an example of why we walk when we see Coventry's name on the other side. Actually, for Frank's other fund, we were bidding on the $4 million policy, and the purchase price we had capped with the IRR we were looking for was $800,000. That was the most we would pay for that policy. Coventry's opening bid, our opening bid was $400,000. Coventry's opening bid was $1.7 million. Right. So they have a completely different buying box than we do. And again, not that the policy, it still worked. The number still worked at 1.7 million, but that's just not a purchase for us. That's a hard pass.
Right. Right. So here, this speaks to AJ's comments about kind of the depth of the fund. If we continue to reinvest and keep working that money, this fund, I think the total outlay for policies was $3.5 million. It's now worth $13 million. By the way, the other $1.5 million was for really premiums and purchases, that type of thing. So these things can cascade quickly, and that's what we're looking to do. Now, remember, on all of those death benefits or settlements, that 10% of that would cheat to the ANPA Foundation, and we would name the ANPA Foundation as an actual irrevocable death beneficiary on the policy. So that's really what we have. I mean, important to note that on life settlements, there's no correlation between the stock market, housing markets, and interest rates. A $500,000 death benefit is going to be $500,000 when the insured passes, irrespective if the S&P is up 100 points or down 100 points. They're safe as a bond. I mean, somebody is going to pass, and quite frankly, if our job is, if there's an opportunity to create a liquidity situation by selling the policy, we will certainly take a look at that. You don't get a 26% internal rate of return on many investments, none that I know of, and I've been in the business a long time.
Well, I'll put it this way: it's the only asset class in the world that is as safe as a bond, meaning it's backed by Prudential, it's backed by Lincoln. As long as you continue to pay the premiums, the policy will remain in force in perpetuity. But it's as safe as a bond, but there's the ability to have a hyper return, right? So if someone dies well before there, and that's happened in that portfolio, if you guys go back, you'll see one of the people had passed away at 4 years prior to life expectancy.
Right.
The gain on that particular investment was 400%. Right. So 400% return. So that is also very possible. There's zero volatility because, again, the only person that can make changes to the policy downward is you. The minute Diaspora is the owner of that policy, they're the only ones that can make changes to death benefit. It's got a low carrying cost. Like these premiums, after we premium optimize these things, they run between 3% and 4%. That's where we like to be per year. So if you map it out, even if you had to hold a policy for 10 years, you're still going to make money on that particular policy. Yeah. And the returns are guaranteed to be realized over time. Again, if you have $13 million worth of policies in the portfolio, at some point that $13 million becomes real money. Right.
And again, trying to mitigate risk, right? Maximize the opportunity, but mitigate the risk. I mean, we are very conservative. Again, to build on what AJ had said earlier, we only buy policies from A-rated carriers, right? Because we know that if a settlement occurs, the A-rated carrier is going to pay the death benefit. We're not going to have the arguments. We're not going to. It's just okay. Here it is, and we're paying it. So,
I mean, and most people don't know this about the insurance carriers. So, insurance carriers have to, for every day that they don't pay a claim, there's a 9% annual interest rate on that money coming back to you. So they're trust me when I tell you, they are anxious to pay that claim as soon as possible.
Right. So,
Oh, very good. Thanks a lot, guys. So we
Thank
come
you,
back
Hank.
to the tombstones that you're looking at. For those of you who didn't quite understand what LE means, it's life expectancy, and then IRR, internal rate of return. They were using those terms, rather loosely, and some people may not quite understand that. But let's come back to the reason we're gathered today, the Diaspora Investment and Charitable Life Settlement Fund. Very specifically, we're trying to raise $5 million, which we hope will control at least, emphasis at least, and I'm being conservative because I have to be conservative. One, as portfolio manager. Secondly, for all the other related covenants that go with this stuff. We expect this to control at least $10 million of death benefit. And I am being super, super conservative because the history that we have with, the other Biltmore Fund, for example, a couple of people are invested in it as an example. I'll just put it this way. $100,000 in a different fund is controlling north of $500,000 of death benefit as we speak in another fund. So here we go. I'm saying to you that 5 million and by the way, this doesn't have to be ANPA members only. $5 million will control a minimum of 10 million. That's a 2-to-1. The rule of 72, just using that, okay, if you get a 10% return on your money based on the rule of 72, it takes you 7 years, 7.2 years for your money to double. We're saying to you here that we're going to do that, and we expect to do north of that and 2 times that, by the way, in what is about a 7-8, on the outside, a little north of 8-year time frame. So how do you do good? By investing in the Charitable Diaspora Fund. How do you do good? By recognizing that we are going to, stay back on the tombstone just yet, that we're going to appropriate 10% of the minimum $10 million that we just talked about, that I just talked about. By the way, the math of 10 million and 10% is $1 million. Okay, so if our $5 million investment controls $10 million of death benefits, that is $1 million to the foundation, $1 million more for ANPA's missions. If we end up doing 3 times that, 15 million or north of that, it's $1.5 million to the foundation. So my friends, this is relatively easy. How does this happen? You're going to basically receive 75% of the proceeds, the death proceeds. The other 6.25% or 5%, the other 5% will go to the foundation. For us as managers of the fund, we're giving up 25% of our 20% carry, which means that ANPA gets 10%, 5% from us, and 5% from you, the investor. That's how you're getting the 10% death benefit proceed. So you get 75% of that death proceed. ANPA gets 10% of that, and then the fund managers will basically get the remainder 15%.
Any, in the interest of time, I'm going to ask, bring it up to questions.
Yes, we're there actually.
Yeah, how does this, I know most of my colleagues are saying, what is the ask here? How do we get involved with this? So we know we already have an agreement with you guys to have ANPA Foundation to put it together. How does that work? So what is the next step for my colleagues to act?
If you scan and get yourself in the QR code, or call our offices, we'll get you the appropriate information and things like that.
And then we will also put this on the ANPA Foundation website. We wanted to present this to ANPA people first. And again, this portfolio will not be strictly restricted to ANPA members. but ANPA will be getting the benefit of it. We're going to open it up to everybody else, but because I know how my people are, sometimes they don't want to invest, but ANPA will get the benefit of this. So this is how we are going to do it. So
actually, Stanley,
go ahead.
The investors get the majority of the benefit.
Of course,
if you can show me an investment in the Northwest quadrant, which means high return, low risk, that will give you the kind of return this would give you. So you get the majority of the benefit.
All right, so I'm going to open up to questions. So there's 2 ways or 3 ways you can ask questions. One, you can unmute yourself and ask your question directly. That would be my preferred method. The other way is you can type your questions on the chat, which I will read it, or you can send it to me privately if you are shy. So we are open for questions. We still have some time. Anybody have any questions? One of the questions that I received was already been asked: how many policies will be in a pool? So the ANPA Foundation pool will have between 50 and 100 policies, correct?
That's correct. That's what we expect.
Okay. Does anyone have any questions so far? Don't be shy.
Yes, Dr. Okoro.
Thank you, Prof.
Yeah, good afternoon. Thank you for letting me know about this very, very interesting seminar. And I'd like to thank every one of the presenters. I just want some clarifications. It appears you say you do not deal with insurance companies that have suicide as one of their exclusions in their policy. If that is correct, I wanted to know why. Number 2, I don't know whether you are going to extend this kind of seminar to our colleagues in Nigeria. Because I told Dr. Okoro and I told Dr. Adisa, the chairman of ANPA here, that I didn't get the impression that we are aware of the benefits of insurance, life insurance, term or whole life, generally in our medical community back home in Nigeria. So I want your comment either from the presenters or from members on the panel who may have some information to enlighten me. Thank you very much.
So
before
you chime in, Eni, I think the second part of the question was, I guess you're referring to opening the investment opportunity to people in Nigeria. Is that correct?
That's correct. And then letting them know about life insurance generally.
Okay.
As you know, I've just come back from Nigeria not a couple of years ago. And since I got here, I got very much interested in insurance as
all right. So who's taking the first question about the suicide?
Alex Cole.
This is Alex Jones. I'm the owner of RA Jones Financial. So I've been in the insurance space my family's been in this space for 60 plus years. I'm second gen. My children are involved in it as well with me. So a life insurance policy, no matter who it's written from in the United States, has a 2-year contestability clause.
Yes.
That means even if somebody went and committed suicide, I don't care what carrier it is, they will not pay. Beyond 2 years, the contestability period of that life insurance policy is over. So we are only looking at policies that the ink or when the application was applied for are 10, 15 years over. I haven't bought a policy that hasn't, that the ink didn't dry on the original application for at least 5 years in a long time. So these are policies that have been owned for 15, 20, sometimes even 30 years. I will tell you myself, 12 months ago, 4 of my friends, we bought a $4 million policy on a lady with a very long LE. We were going to buy it and just hold it and then resell that policy. Paid $65,000 for the $4 million policy. And 11 months into that contract, 3 months ago, she committed suicide. And we received the $4 million in interest on that policy. So suicide is part of we look at suicide as organic depression versus situational depression. We may take into some weight of organic depression because life expectancy on organic depression goes down. And we've been seeing a higher rate of suicide in the United States as of late.
So
The second part of your question, you guys you'll have to answer.
Yeah,
so just to
I can
expand
answer
on
the
the
second
first part of the question is what you're saying is you will not buy a policy that's less than 2 years because of the suicide clause.
Right.
That is correct.
Thank you. Amy, can you take the
Let me
second
take
part?
the second part of it.
Let me,
Here-
let me just say one other thing too, is I've been doing this for 14 years. I'm the largest transactional funder in the United States. I've closed well over 10,000 life settlements. I have never, and again, never not gotten paid out on a death claim from a life insurance company. Ever.
Thank
They
you.
pay.
Amy, take this.
Yeah, Dr.
the second
Iyekano,
part.
please, Dr. Iyekano, please just let me close that my question. I wanted to know whether presenters are working with combined insurance company here in Atlanta or in the US. It's a CHOP company. The combined is the life and health arm of the CHOP company, which pretty certain people in the insurance industry are very familiar with. Just wanted to know out of my health from my own information. Thank you very much.
Yeah, we have relationships with the majority of the large insurance carriers that are mostly AAA. To answer that one and kind of dispense of that, I wanted to particularly address your inclusion of Nigerians in outside of the diaspora. We would love to include them. There are ways and there are restrictive covenants that we have regarding Nigeria and certain other countries when it comes to life insurance. One of a number of you who have applied for insurance, one of the questions that usually comes up is, have you traveled to Nigeria lately? Do you plan to travel to Nigeria? And I'll tell you this, you're usually better off making sure that you create some distance between you're going to Nigeria and all that stuff and the response that you give. Otherwise, you're going to be flat denied. There are a few insurance companies out there, by the way, that have policies where they accommodate foreign nationals. We're definitely going to look into that as a way to incorporate Nigerians and so on and so forth, especially Nigerian physicians and things like that, as you just alluded to. But there's a very higher burden to include Nigerians because Nigeria is one of those countries that is not particularly well rated. It's not just Nigeria now, so don't think that you've been singled out. No, there are a number of other countries, but Nigeria happens to be one of those where if there's a nexus to Nigeria, it usually could be problematic. So my caution to you is when you respond to that in your applications, just be mindful of that.
Okay, Amy.
Does that answer your question, sir?
The second part of the question is, can Nigerians, professionals in Nigeria, invest in this fund? I think that's part of the question as well.
Right.
We have to flush that through because there are, there are issues that we have to deal with when it comes to foreigners investing in this country.
Okay. That's the question. Okay. Now, there is a question on the chat. I'm going to read. I know you. Somebody named it, your hands raised. I'll get to you. The question is, what is the duration of the portfolio until payout?
So I mean, I could help with this. So if you focus on males over the age of 75, which this fund is going to focus on, and you just look at statistical numbers, right? In the United States, 4% of 75-year-olds die. 4.3%, I believe, is the number of 476. That number goes up to 5% by 78. 83% of all males will be dead at 85. Right. So
that's not good for us.
I'm just those are just CDC, those are the CDC numbers. And what we're doing here is we're really putting our thumb on the scale by looking at the medical underwriting and picking the sickest of the sick. Right. We're focusing on chronic diseases like heart, diabetes, obesity, chronic obesity, people who are at high risk of getting a stroke, right? Those are the people that we're really focusing on and looking at. So if you have 100 policies in a portfolio, you should see 4 deaths in the first year, and then 4.3 in the second year, just based on the age, right? So these things pay out. These have a tendency of paying out rather quickly. Frank's last fund didn't have a payout for 2 years, but then they were quite substantial after that.
Okay, now the second question that was sent to me privately was, does this buys include whole life and term life insurance?
So the 92% number includes term conversion and whole life in UL. So what a term conversion is, it is a term policy that you can convert in a period of time to a whole life or UL. So that number, that 92%, includes those 3 categories of insurance.
Okay, so somebody have Baby A, have your hands raised. You can unmute yourself and ask your question.
Oh, thank you. What a great presentation. My question, I think part of it was answered in the first part, the duration of the investment period is not kind of like clear. Like, is there any duration, or you just go by the age limit? Because this is going to be like an ANPA portfolio. So is there like duration or anything that the investor need to? And the second part is, I know during the presentation, you have like the minimum investment, about 25,000, but is there a penalty if person withdraw earlier? Or I know you can roll the investment for continuity, but what are the silent clauses that comes with this? Thank you.
Frank, I'll take part 2 of the question. I'll let you take part 1. So the way the portfolio is set up, to make it your choice on whether or not, after a claim happens, whether or not you will roll that additional investment back into the fund, or if you will take your prorated portion of the death claim off the table. And that's a personal choice depending on your finances at the time, right? So, essentially you get a notification from us, which says that there's been a claim filed. And then you'll get a notification from Annie and Frank saying, this is your prorated share of that death benefit. And would you like to withdraw? Would you like to roll? The reason why it's more of a benefit for everybody to roll in the first 2 or 3 years is because if we're buying a policy, I'm just going to give you guys an example. If we're buying $1 million policy for 100 grand, right? That policy, at the end of the day, when the person dies, let's say he dies in a year, now it's worth $1 million. You just turned $100,000 into $1 million. Now you could take that $1 million and you could purchase $5 or $6 million more of life insurance policies. So you just turned a $100,000 investment to a potentially $5 million investment. That's why you roll. And the more you roll, the larger the fund becomes, and the more, obviously the more benefit it is to the investors.
Let me jump in here, because this whole amplification of your investment results, if you don't properly situate the investment, you're going to be faced with very substantial tax consequences for all intents and purposes. So our usual recommendation is use maybe a Roth IRA to make the investment, so that you're investing the seed, and those amplified results will end up being tax-free to you. That's just a point of note.
I think another part of her question was early withdrawal. Are you referring to early withdrawal of your principal, or what AJ was answering, early withdrawal of the proceeds?
Early withdrawal of the principal, just in case you want to change. I know it's good to diversify, as Amy always advised, but let's say something else, opportunity comes up and you want to change your direction of investment, without any penalty. So those are the stuff that need to be Thank you.
Can anybody address early
Yeah,
withdrawal?
so
of
there's
principal?
no penalty for early withdrawal. You know, if you want to withdraw your principal, then we can satisfy that. We do like, and the PPM, the private placement memorandum, suggests a year lockup, and that just allows us to gain traction in terms of purchasing the policies. In terms of duration, so again, the duration of the fund is driven by kind of the life expectancies, right? But for a practical purposes, you know, most of our LEs are between 3 and 5 years, and 80% of the people will pass in that time. So you're looking at, you know, investments of 3 years to 5 years, and in terms of 100%, probably 5 to 7. Now, once we get past the 5th year, you know, it's our job to monitor the portfolio on an ongoing basis. But we may make a decision depending upon what the depth of the investment and the number of policies. We may make a management decision to go ahead and sell the remaining policies that have not settled. But you can expect somewhere between, let's say, 5 and 7 years in terms of duration of the investment.
Okay, thank you. The next question is, how is the amount paid out prorated? Are we notified of the percentage of investment when we invest?
Yeah. So
Yes.
So you'll get a quarterly statement that will show your number of shares, the number of shares that your investment controls against the total portfolio. And every quarter we issue that investment, we issue that statement.
Thank you. The next question is for you. How do we fund this investment? And you did open up the conversation about Roth IRA of 401k, how to fund this, because we know this is a rare opportunity for us. So I guess you're going to have to explain to us about Roth and everything, because some of us may not be able to invest in Roth IRA based on our income as well.
Oh, no, no. You're absolutely right. And there's an app for that, as we would jokingly say. There are ways to get around investing in Roths using what we call Roth conversions and things like that. What we like to do is have you pay the tax as early as possible, and then grow the assets. But yes, it's not about the income that you have, or that, you know, most of you will be disqualified by income to make new Roth investments, yes, to contribute to Roth accounts, but you can convert your traditional tax deferred accounts. And there are some of you who have employers who may offer Roth 401ks and things like that, but you can convert your IRAs and so on to Roths and pay the taxes on whatever you convert, and then blow it up, as in amplify it with these kinds of investment results. I hope that answers the question.
There's another question to that is, so let's talk about taxes. So assume somebody doesn't want to use a Roth and just want to invest $25,000 minimum. How is that taxed? Is that a what's that called again? How's that taxed?
Capital gains taxes,
yes.
You mean?
Yes, capital gains, yes.
Yeah.
Like capital gains.
Yeah, it's like any other investment.
What we want you to think long term here. Our vision is it will take about 7 years. Now, in that 7-year period, we're going to have deaths. As the deaths occur, you will be notified. When you get notified, including the foundation board, you'll be notified, and the foundation board will make decisions about, hey, you know, we've got this windfall $100,000 that's coming from this death. You know, should we take it or should we roll it? We'll confer with the ANPA board and see what plans they may have. So this is the kind of stuff and interaction that we envision as these things happen. We can't stage them because we don't know when people are going to die. So, you know, those things are pretty much why we use the actuaries to do the life expectancy calculations and things like that. But whenever there's an incidence of death, everybody will interact based on what they're looking to accomplish.
Okay, now this is another question. Is I think this was explained during the presentation. It talks about how do you find the people that have short life expectancy to purchase these policies? Do these policies are taken out on the name and get a portion of the death benefit? I mean, I pretty much can answer that, but I'll let AJ answer that.
Yeah, so we have any number of sources that send us cases. There's only a handful of funding companies in the United States, right? There's only a handful that actually do what we do, and more importantly, there's nobody that dabbles in the 250, 150, 200, 300 market, right? That's us. You know, if I'm not mistaken, Coventry won't even look at a policy under 250. So how we get the bulk of our cases is when Alex, who's not here now, but when Alex founded this company, his family had, as he mentioned, had already been in the life insurance business for 60 years. They had 7,000 general agents in their life insurance company that they sold to GE Capital. Those agents, those very agents that worked for him, they get lapse notices on those cases or grace notices on those cases. When they see one of those grace notices come in, they call their client immediately and they say, hey, why are you letting your insurance lapse? Or why is it going to grace? And they'll explain their financial situation. Those cases will wind up on our desk. That's one way we do it. We have radio ads. We've done newspaper ads. You know, we've done all sorts of marketing, targeting 65-year-old and older. So that's how we get the majority of our cases.
Yeah. So it's important to note too. And again, this is where R.A. Jones and Richmond Life Settlement play an integral role. Frank O'Donnell cannot really buy a policy directly from an insured, right? No. That policy has to go through a licensed funder, AJ and Alex, and our fund will buy the policy from AJ and Alex is kind of like the title agent or the escrow agent, and the escrow agent will fund the insured. And then as part of that process and asking or trying to answer the one question, yeah, there are times when the insured does want to retain some of the death benefit.
Yeah, we call that RDB, which is retained death benefit, right? In those cases, we actually like those cases. We covet those cases quite a bit when that happens, because as good as we are, when we do our weekly death sweeps, as we call them, we go through the Social Security Administration's database. We input all the Social Security numbers into the system, and it lets us know if a death's been reported. The fastest claims we have are when the family owns a little bit of the policy, because they'll call us and send us the death certificate because they want their claim filed, and they'll do that rather immediately, usually the day of or the day after an event. So where the Social Security index may take us, they may not update that for 6 weeks, so we may not find out about a death for 6 weeks, even though we're also running obituary searches once a week on these people as well to see if we get any matches. But again, retained death benefit also means it's going to be less upfront cash to the family, which gives us a higher IRR on that policy. So yeah, we do that quite often.
Okay, this is going to be a fireside question. I know there's a question about the $25,000 investment. Minimum investment is just a one-time investment, not an annual investment.
That's correct.
Yeah. So
there's not a commitment. There's not a commitment to invest annually. That being said, you can invest $25,000 as often as you want.
The next question talks about if death event occurs within the first year, can you avoid short-term capital gains tax by rolling it over to
So what we can do, and we've done before, is because of the substantial difference, we've had clients tell us to hold off on filing the claim until 12 months in a day. That we've done.
Okay. All right. And
yeah, but you're only taxed on the proceeds when the fund makes a distribution to you. If the money stays in the fund, you're not taxed. You know, the individual investor is not taxed.
Okay. By the way, this webinar is being recorded. It will be posted on the ANPA YouTube page. The other thing is, I would want to, Frank, I hate to do this to you guys and AJ, but I'm going to invite you guys to the ANPA National Convention in June in New York. We are going to, and I'm going to call you out as well, because this is a hot item for us. I want to make sure that you guys come prepared so people can sign up at the National Convention, the ANPA Foundation table. So that's an ask on a task for you guys.
We appreciate the invitation and we certainly accept it.
Thank you very much. There's a lot of questions. We are way over time, but this is so good. If I don't get to your questions, I'm so sorry. I apologize. But then any be able to take the rest, contact him through here. When will this fund start, Annie?
We are ready to go.
Okay, thank you. Are there taxes involved? It's a good question.
It depends.
Depends. So I would say contact. They should also.
Yeah, we can respond to specific situations around tax planning.
Okay, and then definitely you guys should probably buy a booth on the National Convention. We'll get the information to you. I think this is a big deal for us because this kind of helps us further the mission of ANPA. Do good while doing well. I'm so sorry if I can't get to your question. I didn't realize it's going to be such a hot item. I would like to thank everybody for joining us today at our fourth webinar series, ANPA webinar series.
Stanley.
Go ahead.
You got a hand up, and these 4 points
yes,
how to make money.
Okay.
Forget about the do well, the do good part. They want to do well.
I know, do well, do good.
We're happy to answer the questions, man. I know you want to close this thing, but this is ANPA Foundation's foundation. We're trying to raise money for the foundation.
I'll ask one more question. Abraham Chukwu, you can unmute yourself and speak.
It's contact information, but I didn't see it posted.
It's right here. If you can scan
this one. Okay, I have it. I didn't see his name, so thank you.
Okay, you scan this. Any other last minute question? This webinar is recorded. It will be made available at the ANPA YouTube page. We are going to post it sometime later on tonight. There will be an email sent out to all the ANPA members as well. And if you're on any of the ANPA WhatsApp groups, it will be sent to the ANPA chair group. So ask your chairperson to share information that's sent to them. It will be sent to all the ANPA chair people will receive it. It's up to them to share it in their chapters. So it will be made public to all of us. Any other last minute questions before I conclude this thing?
Thank you, Dr. Okoro.
All right.
Thank you.
Well, thank you everyone for coming. The next ANPA financial webinar will be announced soon. This is joint co-sponsored between ANPA and ANPA Foundation. I look forward to seeing everyone in New York in June for the ANPA National Convention. Have a wonderful weekend.
Thank you, guys.